My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do it, my friends. I'm just trying to make a little money. My job's not just entertainment, but to put it all in context, so call me at 1-800-743-CNBC or tweet me at Jim Cramer. The $1 trillion stock club is hard to join. Well, we've got Apple, Microsoft, Nvidia, Alphabet, Amazon, and Meta enshrined there. Those stocks are doing unbelievably well. Sure, one of these companies could slip back, but right now, I'm actually more focused on who could be the next to trade above $1 trillion. Now, it's an amazing day for the bulls, where the Dow gained 429 points, S&P climbed 1.02%, and the Nasdaq jumped 1.18%. Huge moves, with the S&P taking out the 5,600 level. I think it's worth going over the contenders, the companies closest to joining the $1 trillion club. Because for the most part, these are not traditional technology plays. Of course, it's not just the companies themselves that are driving things. We have a benign backdrop going here. Today, the Fed Chief Jay Powell, this time in front of the House, once again sounded dovish, meaning we're likely going to get some rate cuts, and they fuel rallies. However, earnings season starts tomorrow, so we'll soon be back in real-world mode, where valuations move in response to the actual numbers, not the price targets or the estimate bumps from the analysts. So you could say this is where the rubber hits the road. Well, with what could be the end of the most buoyant period we've had in ages because of real earnings news, what company might be next to cross the $1 trillion threshold? Let's look at the 8 that come closest, going in descending order, and believe me, some are really descending. First is Eli Lilly. By the way, I could hit this for every one of these because they're so good. At just over $893 billion, Lilly seems to be well on its way to $1 trillion market capitalization. They got the world's hottest drug, this GLP-1 formulation, helping diabetics and overweight, but it could also help many others: cardiovascular disease, fatty liver disease, hypertension, and perhaps many other indications. Lilly can't meet demand and is furiously trying to build more factories, high-quality problem. It also has a new drug to fight Alzheimer's that could be a blockbuster. I nominate Lilly as the next to join the $1 trillion club. Second, Berkshire Hathaway. Now, this is a very close second, and just under $893 billion, and I could easily see this one crossing the $1 trillion barrier. Lots of moving parts here. A mosaic with an overweighting to insurance through Geico. Apple's a swing factor here, right? They got a monster-sized position in Berkshire. A lot of industrial exposure. Berkshire can go over $1 trillion, but I think would actually need lower interest rates, as Wall Street seems convinced that lower rates help this stock more, say, than any sort of the technology names. Even as I'd argue, there's enough here to go higher regardless of the short-term direction of interest rates. There's always some trepidation about Warren Buffett's age. I think that Berkshire could certainly go trillion in a couple of months' time at this pace. The top two, though, could easily be surpassed by the real wild card in the group if we get one more surge in the stock of the unsinkable Tesla, which has been up for 11 straight days. Now, these days, Tesla's being pitched as more of a technology company than an automaker. At $840 billion, they just need to demonstrate that Tesla Energy could become a much bigger piece of the business. We know that Tesla's vehicle sales are leveling off after a period of decline. We know their self-driving initiatives could be the biggest thing going. It's certainly what Elon Musk seems to believe in. He'll talk about it at the August 8th robo-taxi presentation. We also want to hear about what he's saying about China, because China is allowing robo-taxis in several of its cities. Now, it could end up being a gigantic market. This one's got a lot of momentum. The next techie liable to reach the $1 trillion club is Broadcom. We don't talk about enough, symbol AVGO, the tech empire built by Hock Tan that's integral to the data center. Broadcom helps connect the best of NVIDIA's chips to the networks of the world. It's difficult to imagine how the data center or AI would work without Broadcom. Without it, look, it's got a tagline it'll keep you remembering. It's called Connecting Everything. We own the stock for the Travel Trust. Been a big winner for us because we believe its recent acquisition of VMware is just beginning to get integrated, and because its other businesses related to cell phones, well, that's about to heat up thanks to the new product cycle. All the cell phone components say were bid up because of some very bullish projections for Apple phones. But Broadcom stock barely moved. That seems wrong to me. And you know what? I think this is one where you have to buy. Even though I don't like to buy right ahead of a stock split because there's usually so much churning. Now, there's so much to like here, not the least of which is this stock split? Let's talk about it. It's a 10-for-1 split. It's effective next Monday. That will make Broadcom shares more accessible to you regular investors. At $812 billion, its market cap, I think it's an easy striking distance. But Nvidia went down for a while after it did its split, and so did Chipotle. So just be aware. I like the situation, but I am worried about the overhang of the split. There's a huge drop-off after Broadcom, but any of these could catch up if we get favorable sector rotation in the next couple of years. Yeah, years, not months, because these are way down. Can a bank, for example, ever be worth $1 trillion? If anyone can, it's J.P. Morgan, which reports Friday morning. Now, this is a $597 billion situation. The numbers are up at 800. There's nothing in this 600, 700 area. But I'd be a huge stretch to see this one go to $1 trillion. But think about it like this. J.P. Morgan, the best bank in the world, sells for only 12 times earnings. I think that's way too low. It's way lower than the average stock in the S&P. And if the Fed starts cutting rates, then I think this one could undergo some huge multiple expansion, especially if the company also reports a blockbuster set of numbers on Friday. In the end, J.P. Morgan has generated a level of earnings consistency that merits a much higher stock price. Many thought that the last quarter was weak and the stock just got clobbered. But, it's come all the way back. Clean, resilient. Don't rule out $1 trillion, but it's going to take a couple of years. However, if there's anything at the $500 billion level that could double, and double within a reasonable period of time, I bet it's Walmart at $566 billion right now. America's largest retailer is experiencing an amazing moment. It's pulling away from all the other retailers, save Amazon and Costco, which, by the way, just raised its membership fee tonight and keeps rewarding Investing Club members because we've owned it forever. Walmart has an e-commerce initiative that's so strong, so broad, that it's attracting a huge following, although it takes some time to make it truly formidable. This morning, Piper Sandler said that Walmart could have $14 billion in ad revenue by 2030. Now, that's got to be pulled forward for this company to hit $1 trillion. What I like most is the Walmart Plus membership initiative. Recently, Walmart offered important discounts on fuel at Exxon and on flights, hotels, car rentals for the summer season. Take a look at the bargains. It's all on the website. It's really pretty amazing. There are so many different deals and discounts that it's become one of the most attractive loyalty programs in the world, if not, frankly, the most attractive. Seventh is Visa, and it took it on the chin today with a downgrade from Bank of America, questioning whether the company can grow sales above 10% over the next 5 years. Visa is the quiet half-trillionaire. It just continues to be the asset-light, risk-free financial technology play that doesn't get talked about enough, given how consistent it is. But can Visa tackle another $500 billion in market cap? I think they'd need to make, multiple decisions, maybe multiple acquisitions to have something happen like that, and I don't see that happening. Finally, there's Exxon Mobile, which was the largest company in America all the way back in 2011. Before that, it had been a fixture in the top 5 list for many years. The ascendance of tech knocked it well off its perch, but at $502 billion, look, let's just a little speculate here. It's not a stretch to imagine Exxon joining the trillionaire club. If oil prices were to truly spike, the earnings would soar, and this stock would indeed go substantially higher. I'm not betting on higher oil, but it could definitely happen at some point in the next 2 years. So let me give you the bottom line on this speculative piece that I put together here. There's no $1 trillion derby. Nobody's really doing any handicapping, maybe except for me. But I think it would matter if a non-tech could crack into the sainted billionaire circle, because that would call the most bearish judgment into question. That judgment is that we're merely riding a tech bubble. To me, it's going to be Lilly up next, but the sheer popularity of Tesla might allow Musk to sneak back into the top rung, turning the Super Six back once again into the Magnificent Seven. Ron in Florida. Ron.
Hey, Jim. So what happened to Netflix today, given the higher price targets, and what direction do you see the price going into Friday's close before earnings next week?
I have to tell you that Netflix has become so loved that I was actually glad that it got cooled off a little bit today, because every day another analyst, I actually put this in my memo. I sent a memo out to about the 10 things that I'm looking at for club members, and I put together initially in my first cut, I said enough with the Netflix already. You can't just keep raising them the same thing. That's what people are doing. Let's wait and see, but I think it's fine. Mike in Illinois. Mike.
Hey, Jim, thanks for taking my call.
Of course, Mike, good to have you on the show.
All right, I'm very curious why that the stock of Wingstop is selling off. It's down about 12% since its high a couple weeks ago.
Let me give you my answer to that one, Mike. We happen to have Brinker, which is Chili's one later this evening, and this whole group has come under pressure ever since McDonald's cut its price and offered that value package. Everybody thinks that that you can't get the big deal anymore at these guys versus McDonald's. I think they're wrong. I think Wingstop's a buy. Let's go to Steve in Missouri, please. Steve.
Hey, Jim. I always appreciate talking to you.
Thank you, Steve. How can I help?
I'm calling about one of our club stocks, Lindy. It rocketed higher when it reported earnings in February, and then it reported earnings in May, and it's been struggling. Where are you on Lindy?
Okay, I got to get Sanjeev Lambo on the show. He's the CEO. Here's what I think happened. Lindy had an amazing run, like many of the industrials, and then it didn't have a blowout quarter, and the stock didn't get hit, but it didn't go higher. It needs to be able to show, I would say, a reignition of growth, of volume growth. That's what it really needs, is volume growth. And I'm going to touch base with Jeff Marks again tomorrow on this. We do have a club monthly meeting next week where I think I should bring it up after your great question. Thank you. Now, I think the Bears have to take note if a non-tech company can crack into the glorified $1 trillion club, because it would end the idea that we're merely just riding one more big tech bubble like in the year 2000. On Mad Money tonight, fast food fans are growing frustrated with the rising cost of combo meals, but could casual dining chains like Chili's be filling the void? Kind of like the question we just got about Wingstop. I'm sitting down with the CEO of Brinker to find out that what the heck is going on with the stock of hims and hers. I'm giving you my take on the volatile action. And you know the famous question, if a tree falls in a forest, does it make a sound? But what about if lumber prices fall in the market? I'm searching for answers, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Lately, the big restaurant chains have been seeing real pushback on prices. Either they give customers better deals or their traffic starts to evaporate. Yeah, but a handful of restaurants have been ahead of the game the whole time, like Brinker International, the parent company of Chili's, with its famed 3 for Me deal, as well as Maggiano's. That's that family-style Italian eatery. After hitting a 52-week high of $76 at the end of June, Brinker shares have cooled a bit, pulling back roughly 14% to 65 and change. You know, I think it's a good entry point, though, even as competitors finally step up their value offerings. Don't take it from me, though. Let's check in with Kevin Hochman. He's the president and CEO of Brinker International and the president of Chili's Grill and Bar to get a better read on the situation. Mr. Hochman, welcome back to Mad Money.
Hey, thanks for having me on the show, Jim. I just want to do a quick shout out to our teams for Maggiano's and Chili's in South Texas. They obviously got hit by the hurricane there. All of our employees are accounted for, and we're getting the power back on all the restaurants as we speak. And just wanted to recognize Robert Mason, who's our Vice President of Operations in that region, and all the employees that have gotten us back up and running.
Well, I want to thank you for doing that. And on your conference call, when someone does a good job, you call their name out. I've always wondered why more CEOs don't realize it doesn't cost anything to mention people's names who do a good job.
Yeah, we have over 60,000 that do an amazing job. You know, we are definitely, on a roll on Chili's, and we're getting there on Maggiano's. And it's because of the 60,000 employees that are making our guests feeling special, delivering amazing value every day, and it's having great results.
Thank you, Kevin. Now, I want to ask you, in the last conference call, which was now back in April 30th, you were talking about how there is a real pushback. The consumer's frustrated by the fast food prices, and it's been playing in their hands, particularly at $10.99, 3 for Me. Now, since then, it's almost as if these big fast food restaurant chains heard you, and they've been cutting prices and offering deals. Has it hurt your traffic?
Yeah, I can't comment on existing traffic right now. We just finished a quarter. We're going to have an earnings call in about a month. But what I can tell you is we're going to continue to offer industry-leading value. We know that's what the guest wants. They're looking for a great price point, a full meal. They don't want to get nickeled and dimed and have to buy other things once they get to the restaurant. And with our $10.99 3 for Me, it really is a complete meal. We think it's the best value in the industry, and I think we'll continue to go drive that as long as it continues to work.
Now, I just have to ask you point blank. How come you can do something for $10.99, a big smasher burger, and when I go, I'm not going to pick on any particular fast food because I happen to go to all of them. I really don't get, I'm paying the same price, but I'm not getting any service, and I'm not getting the big enough burger as far as I'm concerned.
Yeah, well, one of the most important things, Jim, especially in an economy like this, is to make sure you have offerings for all guests. Some of the guests want, a low price point. They want to have a great value, great quality, and the $10.99 is going to deliver that for them. But that's only about 7% of our business, right? If you think about the rest of our business where you can trade up to either double burgers or steaks or premium margaritas, that's where most of the business is transacting. And when you add up all of that, even with a pretty good food cost on $10.99, we can make things work. We can continue to expand margins, continue to grow sales, and the customer's rewarding us for it. You saw that in our last earnings call, and we'll continue to deliver superior value as long as it continues to work.
Well, I know that you have been a big believer in something that I think is very important. It's not that they come in there and just do $10.99. They order other things. It has to do with actually a feeling of not being ripped off. The American consumer right now feels like they've been ripped off by hyperinflation, and you are an answer to hyperinflation.
Yeah, I'll tell you something. I learned this, it was about 9 years ago. I was personally doing a focus group. We were trying to test some value concepts with customers. And, what we were told is, look, I don't want to do a lot of thinking about the value. Like, I just want it to be easy for me. I don't want to have to download an app. I just want to be able to get it every day. And I don't want to do a lot of spending. And what they meant by that was they want an attractive price point and they want to have superior value. And that doesn't mean the cheapest thing on the block or the cheapest thing that we have in our restaurant. They want something that's going to literally fill them up and not nickel and dime them. And that's what we're doing with the 3 for Me right now. It's a complete meal. It's a price point that's really clear. You don't need to trade up or add things to it in order to have that great meal. And you don't need an app to download it. And you don't need to come at a certain time of day or a certain day of the week. It's always going to be there for the guest. I think that's where we're getting rewarded for it.
Now, I also know that you do a lot of specials. I mean, and you don't want to tinker too much. You make you do $200 million worth of fajitas. You don't want to change the fajita, but you have to keep coming up with something new for people to come in.
Yeah, well, there's two things that, in an economy like this, that's really important. Number one, as guests pull back trips in the industry, it's really important to uplift our service model, right? Because if they're going to take less trips, they need to make sure that they go to places they can trust because they can't afford to have a bad experience. And that's, number one, what we've been doing is upping, all of our guest scores, putting more labor in the restaurants, making sure that we simplify the menu so we can deliver it to the guest. The second thing is you got to keep value interesting and you got to bring some new innovation into it. So, for example, our Big Smasher Burger, it's doing exceptionally well at $10.99.
Yes.
We just launched as part of, you must see a lot of shark content on TV lately. We have a $6 margarita of the month called the Berry Shark Bite. I'm getting it right now. And it's got Luna Azul tequila. It's got coconut Malibu rum in it. It's got fresh sour, and it's only for $6. That is a jaw-dropping prices, like we like to call the Berry Shark Bite margarita. So as long as you keep those things fresh, keep the value coming, we think the guests are going to continue to come back.
And I want people to know that would be at my old bar. That's a $12. That's a $12 margie. So you're doing it for half of what you would do at another restaurant. That's really what an amazing price. One last thing. Are you still monitoring where you are with this? I love this. The GWAP, the guests with a problem that have dropped to 3.3. Is that still going down?
Yeah, so we look at that literally on a daily basis. Now, I can't share with you the most recent results. Once again, we're in a quiet period given our quarter ended. But we're continuing to add labor to the restaurants. We're continuing to simplify things. And so there's no reason why we wouldn't continue to see progress as long as we continue to do the right things for the business. And we continue to do that. The guest experience is going to continue to get better, and they're going to continue to reward us with their business. And that's the plan going forward. And we hope to stick to it.
Well, look, I want to thank you for fighting inflation, which is what I really think. There's Costco, there's you. I got Texas Roadhouse, and then everybody else, Walmart. Everyone else just keeps raising prices. So obviously you can make a lot of money for shareholders and still let the customer have the greatest deal. That's what I think of when I think about Brinker.
Yeah, I appreciate that. I think as long as we continue to win with the guests, have a proposition that they're excited about, they're going to continue to reward us, and they're going to continue to reward our shareholders. So that's the plan going forward, and we're going to stick to it.
Let's call it good business sense. Kevin Hochman, President and CEO of Brinker, symbol E. Thank you. Always great to see you.
Hey, thanks so much, Jim. Appreciate you having me on the show.
Of course. Mad Money is back after the break.
Coming up, what the heck? A health check for a modern stock with time-tested headwinds. Next.
Earlier this year, we spoke with an outfit called Hims & Hers Health. And if you somehow missed the ubiquitous ads, this is a digital health and wellness platform focused on sexual health, skincare, mental health, and weight loss. Basically, they set up a website where you can talk to doctors via text in order to get treatment for, let's say, more sensitive health issues. They sell generic versions of treatments for ED and for male pattern baldness. Somehow the rest of the world still hasn't recognized that bald is beautiful. Weight loss drugs from what are known as compounding pharmacies. That's the other thing they have. These are GLP kind of knockoffs. In short, they treat anything embarrassing where it's easier to talk to a computer than a doctor. All right, that's the basic idea behind Hims & Hers. Now, when we first spoke with CEO Andrew Dudum in late February, the stock was just red hot. And it gained more than 30% in a single day after the company reported a strong quarter and issued a very bullish full-year forecast. That breakout into the teens in late February was important because Hims & Hers Health came public via a SPAC merger that closed in early 2021. And this was the moment it finally broke out above the baseline SPAC level of $10. Even late last year, the stock was stuck in the mid-single digits. Just another post-SPAC play that wasn't working, that hurt people. You know what I mean. But ever since that blowout quarter in February, well, the market has started taking this story very seriously. Now, I bring all this up because after some choppy trading in March and April, Hims & Hers started rallying like crazy. From early May through mid-June, the stock climbed from around $11 to a high of $25 and change. I don't know if you saw it. It's almost like levitating every day for pulling back to $20 and change today. Still, even back down here at $20, the stock's up 127% year to date and up just another 50% since our late February interview. So it's long past time to play catch-up and explain what the heck is going on here. First, when Hims & Hers reported in February, they not only reported strong growth and a surprise profit, management also gave incredibly bullish guidance. CEO Andrew Dudum explained on this show that the whole business model is about breaking down barriers to access for these drugs, which brings a ton of new people into the market. The stock took off again after Hims & Hers reported another phenomenal quarter in early May, a monster top and bottom line beat, up 46%, subscribers up 41%, earnings before interest, taxes, depreciation, and amortization growing by 434%. Company earned 5 cents per share, analysts were only looking for a penny. Now that's a smoke show. Management said it could put up these numbers because they were offering a wider breadth of product categories on the platform, including weight loss drugs. In response to the quarter, the stock immediately jumped 6%. But that wasn't even the biggest positive catalyst of the past couple of months. On May 20th, 2 weeks after the first quarter report, Hims & Hers announced that it would start selling GLP-1 injections. Remember, people are desperate for these revolutionary weight loss drugs. That said, the company isn't actually selling the patent-protected stuff from Eli Lilly and Novo Nordisk. Instead, they're selling what's called compounded medications, which use the same active ingredients in a copycat formula of the drugs. Normally, the regulators won't let you violate someone else's intellectual property like that. Those compounded drugs are only allowed in situations where the supply of the real drugs are limited, which is exactly what we have with GLP-1s. Crucially, this product that Hims & Hers is selling isn't actually FDA approved, but the upshot is they're selling the active ingredient for a much lower price than you can get anywhere else. It starts at $109 per month, which is a fraction of what the real Ozempic or Zepbound costs. When Hims & Hers announced the new access to GLP-1 injections, the stock rightly jumped nearly 28% in a single session. Even as the news wasn't exactly a surprise. I mean, people have been speculating about this story for months. How big of a business could this be for Hims & Hers? Analysts at the healthcare-focused research firm Leerink Partners took a stab at this question last month, and here's how they put it, quote, "We have built our first cut at a sensitivity analysis to understand just how big the opportunity could be with with estimates that get quite large, quite fast," end quote. Quite large, quite fast. I like that. Specifically, Leerink projected that these compounded GLP-1 drugs could increase Hims & Hers EBIT, that's the earnings before interest, taxes, interest expense and taxes, by anywhere from 7% using conservative assumptions to 150% using more aggressive estimates. That's a lot of leeway, I know. But it sounds pretty positive to me. No wonder the stock more than doubled from early May to mid-June. Hims and Hers finally took a breather once the stock reached its mid-20s. But then something else happened. On June 27th, an outfit called Hunter Brook Media, which is a new venture that's part hedge fund, part media company, and similar in nature to an activist short seller, published a negative report on the company's move into these compounded GLP-1 shots. Their thesis. First, Hunter Brook points out that Hims & Hers' ability to sell these compounded GLP-1 drugs could end at any time. And that is true. Like I said before, you can't just violate another drug company's patents. It's only allowed as a temporary measure when there's a shortage of something important. We know that Novo and Lilly are working really hard to bring more production online. And if they're able to get more supply, then these compounded drugs, they'll just stop. They'll be shut down. But you know what? Demand for these GLP-1s is so strong that I think it'll be some time. Might be a while before there's enough official supply to sate the demand. I'd add that Hims & Hers has said that they'd like to work with Lilly and Novo Nordisk to get their users access to the real thing. That's nice to hear, but it comes with additional questions, including how much of a margin did they take from that change. The lower price point of the compounded GLP-1 is a huge part of the appeal here. So switching to the real thing, let's just say, certainly wouldn't be all that lucrative. The other relevant negative from the Hunter Brook report on Hims & Hers, the authors argue that the company's getting its compounded GLP-1s from a single supplier, Berkshire Pharmaceuticals, which has, in their words, quote, previously unreported ties to fraud and bankruptcy, end quote. Now, that was news to us. It was certainly not a great look for Hims & Hers, though. I'm not sure how much it impacts the estimates. The Hunter Brook report also said basically that people can get the compounded GLP-1s through Hims & Hers without speaking with a doctor, which opens the company up to litigation risks, especially as these compounded GLP-1s are not FDA approved. Okay, at least they're putting it out there. Now, the stock had already pulled back from 25 to 21 before this Hunter Brook short report came out, but then it tumbled to 20 after it came out and it traded sideways ever since. So what do we do with the stock here? Okay, frankly, I'm actually torn about this one. While it makes sense that the stock's roared on the compounded GLP-1 news, I don't love that it's now trading on what's essentially a temporary business. However, I liked Hims & Hers before this whole GLP-1 dalliance sent into the stratosphere. Those great first quarter numbers didn't have any benefit from knockoff GLP-1s, and I bet the business stays strong. So the bottom line here, I'd never recommend paying up for Hims after that big run at 25. But now that it's pulled back to 20, I think you can justify building a position here, especially if you buy it gradually on the way down and don't place all your hopes on the temporary GLP-1 business, even as it is incredibly strong. Let's go to Mike in Illinois, please, Mike.
Hey, Jim, how are you?
I am good, Mike. How about you?
I'm great. I want to thank you for all you've done for me and for all the numbers. You guys are exceptional. You and Jeff have helped me out a ton since I joined. I'm up over 40% in my portfolio in the last year, and I'd say you were a good reason, one of the major reasons that happened.
Oh, thank you. Jeff and I were talking back and forth today. We got a meeting coming up next week. We're going to try to review what we talked about at our annual meeting, give like a 6-month look-see. But thank you. You encourage us, makes us work harder. I really appreciate it. How can I help you today?
Well, one of my dogs is Abbott. It's actually my biggest dog. I'm down about 9% since I bought it. I've added to it a couple times. I know it went up today. I know you said that this loss is going to come through and not be nearly as damaging to the stock, and hopefully it'll bottom at that point once that comes out. But I'm wondering what you want me to do, buy, sell,
well, let's take this. Let's take it. You know me. I take it head on. They report on the 18th. I don't know. I think the company's doing incredibly well. The lawsuit is in Missouri. It's the worst venue. That's why I prepped everybody to think that they could lose it, even though I don't think they should, which is why we're holding off buying any more until it breaks under 100, or else we're happy with our position. That's our plan. And I thank you for those incredibly kind words, and I'm sure Jeff will too. Let's go to Richard in California. Richard.
Hi, Jim.
Richard, what's up?
You always say pick best in breed. Well, this company is only in breed. This AI tech service company is exploding in all financial metrics. They just entered a very large market in Texas. Growth will be rapid. All their core markets are growing like a weed. The White House has them in the Moonshot program to help end cancer, and they're at the top of their list. Their breast, prostate, lung cancer AI is already up and running with serious revenue and growth. They're developing generative AI to run all basic company needs, billing, appointments, workflow, etc. It will be a game changer for profits by year end. Most importantly, this product will be for sale. It will revolutionize healthcare services, hospitals, imaging centers, diagnostic centers. This company's growth over the next 12 months and beyond will be mind-boggling. Radnet.
Oh, Dr. Berger. Yeah, I mean, this is one of the reasons why, candidly, I thought that GE Healthcare would be doing better because they're a big supplier to RadNet. RadNet is just doing incredibly well. You're definitely right. It's a very interesting story, and every time we've had them on, it's been terrific, and I think it's going to stay terrific, and it's a really good call by you. All right, listen, as long as you're not centering your investment thesis for HIMS around its GLP-1 business, then I think you can start building a position at these levels. Much more mad money at Weyerhaeuser has been going down, but is it too late to yell timber? I'm checking in on where the lumber producer stands after its recent severe underperformance. Then, the only thing more torrid than the love for tech hardware stocks is the absolute hatred for enterprise software. I'm giving you my take on the love-hate relationship, trying to make some sense of it. And all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer. I love it when key commodities come down in price. Shows we're winning the fight against inflation. But what in the world is happening with the price of lumber? I know we're in a weird moment for the economy where brown shoots of developing weakness have turned into flashing yellow lights, and the Fed seems inclined to get more dovish, with the possibility of a rate cut in September. That's what I'm expecting now. And that's what you expect when the economy finally cools down. But within this environment, commodity prices are all over the map. Gold and silver are both holding up well. Copper was doing okay before pulling hard down just of late. But iron and steel are very weak. Oil's held up pretty well, although natural gas has broken down completely after a nice run at the start of summer. Now, most agricultural commodities have been weak, except for special situations like coffee beans. Now, it all paints a pretty mixed picture at best. However, lumber tells a much clearer story. The price of lumber has been going straight down for the past 4 months, falling nearly 30% from north of $600 per 1,000 board feet in March to the low 400s now. Now, you might remember that just a couple years ago, at the height of the COVID-induced housing boom, lumber was one of the hottest commodities on the planet. The price of wood climbed nearly sevenfold from about $250 at the March 2020 lows to almost $1,700 at its peak in May of 2021. Extraordinary. Lumber made another run in late 2021 and early 2022 when overall inflation readings were approaching their highest levels. In the end, lumber put in another peak above $1,300 in February of 2022. Then the Fed started raising interest rates, though, and prices collapsed as everyone assumed the housing market would collapse, too. And without housing, there's really not as much demand for wood in pretty much anything else. Ultimately, housing turned out to be far more resilient than anyone expected, and lumber rebounded from its lows. It seemed to be doing fine until it started rolling over again this March. So what's going on here? You know what? It's a classic case of supply and demand imbalance, with some unique twists, though. When lumber prices soared years ago, the industry scrambled to increase production, particularly in the Southeast, where it's cheaper to produce southern yellow pine lumber. That's the right term, southern yellow pine. New lumber mills take time to build, but more production has come online in the past couple of years, particularly production of that cheap southern yellow pine. More important, because everybody expected a bunch of rate cuts from the Fed coming in this year, the lumber companies maintain high levels of production, figuring we get a lot more home building activity and remodeling work. That seemed to be the right zeitgeist, but the rate cuts, they never materialize, at least not so far, meaning mortgages are still expensive and home builders are hesitant to build aggressively. In fact, they've pulled in their horns. Housing starts have been deteriorating since February. May housing starts were down 5.5% from April and down 19.3% from the year before. In fact, this was the lowest housing starts reading since June of 2020. That's not helpful for the price of wood. At the same time, the restoration remodel market, which is even more important in this industry than new construction, has also stalled out. People are putting off projects because the cost of financing is too expensive. They'd rather wait a year or two betting, getting a home equity loan, paying for a big renovation, betting that the Fed's going to cut. Now, normally when housing and remodeling slows, you'd expect the lumber industry to pull back on production. This is key. It hasn't happened here. Why? First, the industry invested so much to stand up these new mills in the Southeast. Now that they're operational, they don't want to cut production. In some cases, they borrowed so much money for the new mills that they don't have a choice. They need to sell lumber to service their debts. With the labor market still relatively tight, lumber producers also don't want to lose their workforces. More important, remember, these mills in the Southeast have much lower break-even points than even their competitors in Western Canada, previously the heart of the lumber industry. Plus, there's a feeling in the industry that things will turn around once the Fed starts cutting rates. They think that's right around the corner, so they're holding steady in the hope that they get bailed out by Jay Powell. That's how we get this stunning decline in the price of lumber, an understandable decline in demand paired with stubbornly high supply. Hey, how do you play it? I want you to consider the stock of Weyerhaeuser. That's the Seattle-based real estate investment trust that's one of the world's largest private owners of timberlands and one of North America's largest manufacturers of wood products. Given the decline in lumber prices, it's no surprise the Weyerhaeuser stock has fallen 24% since late March. Hey, by the way, this is the lowest level since late 2020. That decline is justifiable. I get it. But I also have to say that if you have a long-term investment horizon, this is the right time to buy Weyerhaeuser, not sell it. Ultimately, the supply-demand imbalance is temporary. This business is going to bounce back. During an appearance at a REIT, that's Real Estate Investment Trust Industry Conference last month, Weyerhaeuser CEO Devin Stockfish addressed the softer moment for the lumber market, noting that for Weyerhaeuser, the issues are more related to the renovation and remodeling business than single-family housing market. But Stockfish also stressed that his company focused on its long-term, multi-year initiatives, acquiring $1 billion worth of timberlands, raising lumber production by 1 billion board feet, and growing a carbon sequestration business that used to be an afterthought, but is scaling up, and I'm very interested in it and have been following it. Weyerhaeuser has also been cleaning up its balance sheet and growing their base dividend, which currently yields 2.9%. Beyond the base dividend, Weyerhaeuser likes to return excess capital to shareholders via special dividends and share repurchases at management's discretion. I think they've got a great long-term strategy in place, and if you're willing to ride out some of the near-term choppiness, then Weyerhaeuser all the way down here should be fine over time. Honestly, I think the lumber industry's right that we're close to a bottom, and once the rate cuts start to materialize this fall, the home builders will begin to build more, and there'll be more renovation and more remodeling work, and that will improve the lumber prices, and they will be sustainable. It could be a real rally. At the end of the day, we still have a jaw-dropping housing shortage in this country, right? We need several million more homes than we currently have, and over the long haul, that's a huge positive for a company like Weyerhaeuser. It's going to come together, people. All that said, the company reports in about 2 weeks, and given that lumber prices were straight down in the second quarter, and we have to assume that the numbers won't be particularly good. Okay? I'm not telling you to buy Weyerhaeuser ahead of the quarter. I suspect you'll get a much better buying opportunity ultimately after the quarter, but you can't be sure. Bottom line here, the lumber market's collapsing right now, along with the lumber stocks. I think this is temporary, though. After all, this is a classic boom and bust industry, which is why you should look for opportunities to buy best-of-breed Weyerhaeuser into the weakness. Understand the Weyerhaeuser when they report, it may not be perfect. Yeah, Bunny's back in for the break. It is time. Some of the light brown clear festival wrap. We're all insane in this soccer. Thought about buy, sell, particularly or none of the core shop. My staff prepares to look after some play. We play this out. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Cramer's going to start with Dave in Illinois. Dave.
Dr. Cramer, my good mad friend. You know, the weather doesn't get much better here. So when will you and Lisa return to Chicago for some Portillo's and a Binny's bottle signing?
Well, I don't know, but I'm going to check in at the Bear, please, now that I know that Tina's got that job for a long time. There you go. What's going on?
Jim, this $24 billion suburban Chicago company has kept pace with the S&P so far this year. Among Dover Corporation's supply of electronic equipment and components, they make thermal connectors, a critical component in liquid cooling of data systems. So, Jim, with data center spending on the rise, your thoughts on DOV?
Oh, boy, Davis definitely put it once again, right, his finger right on the pulse. That is a terrific, I'd like to come out there and see them. Maybe they'd invite us. This is a terrific industrial company that really is making a great move in the data center. I think the stock can go to 200. I will talk it up next week, just so you know, when I go over what I like for when we have our monthly meeting for the club. Dover's going to be a big name for me. Let's go to Jack in Ohio. Jack.
Hey, thanks for taking my call, Jim.
Of course, Jack. What's up?
Hey, buying for the dividend income, SFL Corporation.
No, if you're going to do that, you want to buy Dow Chemical, no longer Dow Chemical, Dow Inc., which back yielding 5.4%, I think is the right play at $51 with Jim Fitterling at the helm. That's the one to buy. Bob in Illinois. Bob.
Yes, sir. I've been a holder of Kava. And about a month ago, they upgraded their guidance for the year. And since that time, it's gone down about 10%, including 5 points today.
Well, you know, there's a lot of these high technology companies and a lot of fast growers and a lot of companies that just came public in the last 3 years that are really giving up big gobs while the stocks that are, of course, we know Nvidia and Apple keep going higher. I don't want you to lose faith, but you have to understand this is a concerted move by the companies that have come public in the last 5 years. They're all getting hit. Don't panic. Understand they're coming down. One just as a sector rotation. How about Caden in Texas? Caden.
Yeah, hey, Jim, I want to get your take on New Fortress Energy. I know you've been a fan of Wes Eden and New Fortress Energy in the past, and I could talk about this story and all the positives for a while. But to make it short, is it the continued delays of their Altamira FLNG and uncertainty from investors? Cargo delivery was said to be this month, as production was supposed to have started last month, as commissioning is now complete at that plant.
Yeah, I think the problem here is, frankly, that President Biden put a pause. And I know that there's a judge that said no to that, but I think it put the whole multi-year plan under question, and that's why it's going down. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
The only thing more extreme than this market's love for tech hardware is its hatred for software, especially enterprise software. We've had plenty of incredibly positive moves for tech, but with the exception of Microsoft, the gainers have been in semiconductors and devices. Meanwhile, software losers just keep losing, even in today's otherwise upbeat session. The dichotomy was on full display in the middle of the night when Taiwan Semi reported nearly 33% sales growth in the month of June, far better than even the loftiest of estimates. Given that Taiwan Semi is the manufacturer of both NVIDIA and Apple chips, not to mention semis for Broadcom and AMD, among many others, the pin action, it was just incredible. NVIDIA's rallied to another 2.7%. Apple advanced almost 2%. I know I sound like a broken record, but these companies are all part of what NVIDIA's Jensen Huang calls the new industrial revolution. Chips made at Taiwan Semi's foundries are part of the simultaneous march of accelerated computing and generative artificial intelligence. Hardware's in ascendance like I have never seen, maybe in the 90s. And when you consider the size of these companies, the multi-trillion-dollar market capitalizations, it's remarkable. And the gulf between hardware and software, it just keeps widening. This morning, Intuit, a financial service company that I like very much, announced layoffs that management indicated were artificial intelligence related. Intuit's a software company that's been saying that it will be one of the leaders in using AI to improve the customer experience. Now, it does have a host of divisions that can easily substitute AI for employees. And you know what? It made a ton of sense. I understood the announcement. Many of the people let go could be rehired. To me, it sounds like CEO Sasan Goodarzi is doing exactly what the new technology allows him to do, even if it's very tough medicine, of course, to fire people. But the market's reaction was severe, with the stock losing almost 2.6%. Now, some of that may be related to the turmoil that's likely to accompany these layoffs. But you know what? I think the layoffs, I think there was skepticism about the layoffs. Skepticism that this enterprise software company for small, medium-sized businesses may have a slowing or a stalling. The reverberation was swift. We immediately saw enterprise software poster boy Salesforce get hit, as did ServiceNow, even though both stocks did rebound nicely into the close, saved by a positive tape. They never should have been down big in the first place, but you know what? They're enterprise software. In reality, I think ServiceNow is doing incredibly well, and these temporary pullbacks are buying opportunities. But the problem here is pretty simple. The valuation for software stocks are going lower, because they no longer have the level of certainty that money managers are willing to pay a premium for. There have been so many of these kinds of companies created in the last 15 years that they have nowhere near the scarcity value they used to have that you get from major hardware winners these days. And, of course, it's entirely possible that the enterprise software customers simply don't know whether they could be doing what Intuit's going to be doing, making them less willing to pay up for long-term software subscriptions for large numbers of employees. Plus, there used to be a ton of takeovers among these stocks, but Bloomberg broke a story today that Alphabet, which may have been looking at a company called HubSpot, which is kind of a mini Salesforce.com, decided it wasn't interested in HubSpot, and its stock plummeted 12%. Hey, by the way, smart move by Alphabet. It would have crushed its own stock if it had bought HubSpot. At the end of the day, though, hardware's loved, software's hated, exception of Microsoft, and maybe never the twain shall meet, at least not in this environment. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.